Looking at our previous lectures or video, we were able to treat our transactions in the cash book, and we also move ahead to reconcile our cash book bank column balance with that of our bank statement. Those transactions, they were transactions backed with cash payment or check payment. But today we're going to look at those transactions that were in credit, that is the credit transactions. We buy on credit and sell on credit. When we buy on credit, we are buying from our suppliers. They are our creditors, and we're going to pay them back. When we sell on credit, we are selling to our customers, and these customers are our debtors, and they are going to pay us back. So we need to keep an account, to maintain an account that will show the total balance of these creditors and the total balance of these debtors. And that is the simple definition of control account. It's an account that keep or summarize or prepared for us to know our total debtors balance and the total creditors balance. And that is all about control account. But in control account, there are items that are not recorded. In control account, there are items not to be recorded in the account. And these items are items that they were already paid. Items or transaction that was fully paid, and other items that are in estimation. So the control account, that is the summarizing or the totaling of all these items, are from our ledgers. And these ledgers particularly is the personal ledgers. That is personal ledgers. And this personal ledgers is divided into two. We have the sales ledgers and purchases ledgers. So this sales ledgers is, let's do like this. We're going to prepare a sales ledger control account. And when we sell, we debit the sale and credit the payable. So this sale is, we're selling to our customer. We debit this our customer to know that this customer is to pay us, and they are also known as debtors. Or receivables. So since it is the same, debt sales and debtors or receivable, credit sales and debtors or receivable are the same. So you can either say sales ledger control account or debtors or receivable control account. Simple as that. So since control account is for us to know the total balance of this particular ledger, the sales ledger, you may have total debtor or receivable control account, or total sales ledger control account. That is why at times you will see total debtors control account, total receivable control account, total sales ledger control account. All they are the same. Now if you come to this purchase, it's the same thing. You say purchase or purchases ledgers control account. We buy from our suppliers on credit, and it is same as creditors or payable, the opposite of the sales, payables. So now it might also be written as creditors or payables control account. And since we are controlling this purchase ledger or creditors account to get the total, so you can say total creditors or total payable control account or total purchase ledger control account. Very simple. So all our control account is going to be on the sales ledger. If you cannot say sales ledger, debtors control account or receivable control account or sales ledger control account. And the next one is the purchase ledger. The purchase ledger control account, or you can say creditors control account or payables control account. So the next step is items not in the control account. Items not in the control account. A cash payment or check payment, when you buy or you sell, they are not going to be recorded in your control account. Or other estimation items like the provisions and so. So 1, cash paid. 2, check paid. 3, provision for bad debts. 4, trade discount. All these items are other items that you might think of that they are fully paid or are in form of estimation, will not be on our control account. Then let's look at items that should be in the control account. And these items are grouped into 2. The items that reduces the control account and the items that increases control account. Let's see these items. Let's see these items. Items that reduce the sales ledger control account. 1, bill received. 2, bad debt written off. 3, cash or check from customers. Number 4, discount allowed. Number 5, error of overstating. Number 6, return inwards. Number 7, set off And number 8, transfers. So these are items that reduces or that reduced the balance of the sales ledger control account. For example, let's give an example. This is a sales ledger. Sales ledger control account. This is the debit side and this is the credit side, for example. Now, sales ledger is always having a debit balance. We say balance be brought forward of this. So this is our balance. This is the balance that our debtors, that is all our customers, will pay us. This is the balance we expect to receive from our customers for the credit sales. And these items will affect this balance negatively. It will reduce this balance. We want to receive $20,000 and this customer has given us $10,000. So we have received $10,000. So it will less the $20,000 to be $10,000. So don't be confused that whenever you see receipt or you receive cash from the customer or return inwards or set off, I think they are going to the debit side of the control account, sales ledger control account. No, they are not going to the debit side. Why? Because just as I have explained, they are going to be minusing what they're supposed to pay us since they are paying, and it will be affecting this balance negatively. Say we receive, this is, let's say 30,000, and we receive bills of 20,000. I hope you're getting it. So we'll be left with 10,000 here for our customer to settle us. That is all about these items. Now we'll come to your credit side and reduce the balance of this sales ledger. That is, they are settling this balance. But if you bring anything here, you're adding it to this balance. I hope you understand. That is a technicality aspect of the control account. So all these items will be here to set off this balance. Simple as that. When we receive bill, it will come here to reduce this balance. When bad debt is written off, say customer A, customer B, customer C, and customer D. The customer A is to pay us $5, customer C $5, customer D $5. I hope you follow it. Now, this debt for customer B was written off. Say we cannot recover this debt. So it will reduce, it will affect this, our balance. So that is why bad debt written off will be here to less your balance. So cash or check from, we receive cash, the same thing with the bill receivable from the customer, it will reduce what we ought to receive. Discount allowed, we allow a discount. Say if you pay, we'll allow you a discount if you pay today or tomorrow of $2 or $3. So it will reduce what we're supposed to receive. Error of overstating. When our balance here was overstated, the balance was overstated with a certain amount. When this overstating is identified, it will come here to reduce what was overstated. That is very simple. We overstate this account with 3 to make it 30. So you come and remove the overstated or the overstating or overcast balance of 3, it will be 27. That is what I'm saying. That is simple. Return inward. The customer returns some goods to us. So it will minus from this balance. Set off. This set off means these customers, let's say this customer D, supposed to pay all these $5, but we're into a business with this customer D. We buy some items from him, and as well we sell to him. So we've bought item from this customer, say $2 on credit. So the customer might wish to, based on our agreement, to set up the balance. Very simple as that. Say the customer will give us $3 instead of $5 because of this set off that we're supposed to pay them. That is set off. The set off will be here. Set off, say the $2. So this customer, it will affect our balance. It will reduce it because he has set off the balance. As simple as that. So transfer. This transfer is somehow technical. Transfer will affect both sides of the account. Say this is a sales ledger. We are transferring a debit balance to the purchase ledger. So if you're transferring a debit balance to the purchase ledger from the question, you come here and say debit balance to purchase ledger. Very simple as that. It will show that you are taking this, will minus it. It's affecting this balance. We are taking from this debit balance out, it will reduce this debit balance. And you will put it here to less it, what we're taking out, transfer out to purchase ledger. I hope you are getting it. If it is, we are transferring our credit balance, is the same treatment to our purchase ledger. We are transferring, you show it here, that you are transferring your credit balance to purchase ledger. Very simple, because when you are transferring this, your credit balance, this, let's say this bill, you are taking it to the purchase ledger, it will come here and increase your balance because you are no more removing it again. You are taking it now to the purchase ledger, and it will come back to add to the balance that was deducted with this $20. So that is the treatment. If the question say we transfer a debit balance from this sales ledger to the purchase ledger, the debit balance will not show here. If you show it here, you are adding. It will come to this credit side and say debit balance to purchase ledger. If you are transferring a credit sales ledger balance to the purchase ledger, you come to debit side. That is, an item that initially reduced this balance is now back again because we are taking it to the purchase ledger. So this is all about the items that reduced the debit balance of the sales ledger. You are done. This is a comprehensive item. This is a comprehensive item. So there is nothing like cramming. All those things that come in, all those things that you receive, they return to you. It will reduce what the customer is supposed to pay you. A set of, just as I've explained, it will reduce the balance. Error of overstating, it will reduce the balance. Cash you receive from the customer, it will as well reduce the balance. So they will be at the credit side of the sales ledger control account. Simple as that. So let's look at those items that will be added. If they come, we will be adding them to this our balance of the sales ledger. Whenever these items are coming, they will be added to this balance. So, and they are not any other items. They are the items that maybe you are giving them to. If you give the customer or the debtor another credit, it will increase your balance. Whenever you do anything that you are giving it out to that customer, it will increase the balance you already have in your sales ledger control account. So I think you're getting it very well. Yes, getting it. So now, those items that will increase our sales ledger control account, they are those items that will be going out from our business. It looks as if an opposite of our normal accounting, say whatever you give out in credit, yes, because this is a credit transaction. This is a credit transaction. So since we are giving these customers, it will be added to the balance that we're supposed to receive. I hope you're getting it. If we sell again to them, say items that increase the sales ledger control account. Say 1. There was an additional sales in credit. You say credit sales. I hope you're getting it. You sell again in credit. It will increase the debt balance, the debtor's balance, what you should receive. Now, the opposite of all this, will add to your balance. Simple as that. When this bill is received and the bill is dishonored, this bill dishonored will add to your balance. All the opposite of this. Bad debt written off, you say bad debt recovered. I hope you are getting it. Cash or check received, you say check number 4. Check or cash dishonored. Number 5. If they all are the opposite, they will add to your balance. Here will be error, that is discount allowed. If you wish, you disallow the discount. Discount disallowed. But it's not common in most of our questions. So it is not common. So we'll move to the next item. Error of oversetting. Here will be error of understating. I hope you are getting it. Number 6, return inwards. Set off. Trade, set off and transfer. 6. Transfer. So 7, we may say cash refund to customers. Yes. So when this cash is refunded to customer, it will add to your balance. It's the same thing with check dishonored. This cash that we receive, we refund it back to the customer. Maybe the cash we received was not the cash we're supposed to have received from the debtors. So since it's not the cash, we will refund the cash back. So it will add to our balance. So these items, they add to our sales ledger control account balance. Simple as that. So now let's look at the comprehensive format of sales ledger control account. Say sales ledger or debtors, total debtors control account or total receivable control account, all the same. Sales ledgers control account. Here is credit and it is minus. Here is debit. Here is debit and it is addition. So you do like this. Okay? We will have our balance brought forward. This currency sign, your dollar, your currency sign, your dollar. Balance brought forward. So all these items that reduce our balance of the sale ledger will be here to reduce this balance. That is what we are saying. And in some question, your credit side may begin with a balance brought forward. I hope you understand. The result may be an error. So it will come here as balance brought forward at the credit side to reduce from what the customer is supposed to pay. There was an error to this amount. So the balance will come here as balance brought forward. So then these items will now follow. These items will now follow. That is what we're saying. You say bill, receivable, simple. All these items, bad debt, written off. I hope you're getting it. Cash or check from customers. Cash is like check from customers or debtors. Then discount, you allow the discount. Discount allowed. Simple as that. It's very simple. Error of overstating. Error of overstating. Return inwards. They return the goods to us. Return inwards. Set off the balance. It's very simple. Transfer. Very simple as that. This is the items that will reduce this balance. So those items that will add to this balance is either you sell or credit again. You say credit sales, credit sales. I hope you understand. Then bill dishonored, bill dishonored, bills dishonored, bad debt recovered, bad debt recovered, then check dishonored, check dishonored, error of undercast, error of undercast, transfers, cash refund to customers, cash refunds to customer. Simple as that. This is how your sales ledger control account should look. This is how it should look. And if there is any item that either increase or reduce the sales ledger control account, you will put it from the equation. The necessary thing you need to know is for you to know that whatever is going, it will be adding to your balance to increase the debt. And whatever you're receiving from the customers will be there at the credit side to decrease or reduce the balance. That is, they are clearing the debt. Simple as that. Now, let's look at the purchase ledger control account. So the purchase ledger control account is the opposite of all what you have seen in the sales ledger control account. It is the opposite of it. So items that reduce the purchase ledger control account, they are the opposite. So these items that reduce the purchase ledger control account, they are items at the debit side. Since purchase ledger in a normal circumstances carries credit balance, not debit balance. That is the difference. Since it is a credit balance, the transaction or the entries will be the opposite of the sales ledger control account. Simple. Now, let's look at it. These items that reduce the purchase ledger control account, they are the same items like this, but not what? Receipt, because we are paying, the business is paying the supplier to reduce what our credit, what we're supposed to pay, to reduce what the balance that we're supposed to pay our creditors. So when we pay, it will reduce the balance that we're supposed to pay to our suppliers. I hope you are getting it. Or when we receive another in addition, another item or another goods in addition, it will add to our credit balance with the creditors. So it's the opposite. When we receive, it will add. When we pay, it will less our balance with the creditors. So here will be 1. The same thing, bill payable. 2, there is no bad debt. It is the creditors that are supposed to, it is the creditors, when preparing their account, we notice that this debt is not recoverable. I hope you are getting it. So the next will be cash or check. Here will be cash or check to creditors. I hope you are getting it. It's the same thing. Here will be discount allowed, discount received, discount received. I hope you're following. It's simple. Control account is very simple. Error of overstating, yes, there will be error of overstating. It will reduce overstating. 5, return inward, here will be return outward, returning the goods to them, and it will reduce our credit balance. Return or returning these goods to our creditors, and it will reduce our credit balance. Return outward. I hope you're getting it. So set off. Set off and transfer. Very simple. Another item that you think, if you see it in the question, will reduce what you have to pay to the customer. I hope you are getting it. Now, these are the items that reduce the balance we have to pay to our creditors or suppliers. Now, let's look at the items that we add. Items that increase the purchase ledger control account. Control account. So these items are the opposite. These items, the opposite of these items. So these items are the opposite of these items. If there is another credit purchase, just as we did for this. If there is another credit purchase, credit sale, credit will purchase a credit. You say credit purchase. 2. Then the opposite of all this item. Bill payable dishonored. Payable dishonored. Number 2. Cash or check. You say check dishonored. Check dishonored. And 4. Cash refund from creditors. Cash refund from creditors. Number 5. Discount received. Error of overstating. Error of understating. Error of understating. Number 6. Nothing charges. Number 7. Transfer. So these items increase your purchase ledger control account. So in our next video, we're going to look at the format of the purchase ledger in a detailed form like this, and we continue to solve a practical example. Thank you so much.